20% of the world's oil passes through a body of water that is 33 kilometers wide. The Strait of Hormuz. At its narrowest, you could see the other side. For decades, this corridor has been the quiet engine of the global economy. Tankers moving through day and night, carrying the energy that keeps the lights on in Tokyo, the factories running in Frankfurt, the trucks moving across America. On March 2, 2026, that corridor closed. Iranian drones struck Qatar's gas infrastructure at Ras Laffan, the nerve center of the country's entire energy export system. Qatar is not a minor player. It is the world's second largest exporter of liquefied natural gas. When those facilities went dark, Qatar's national energy company did something that is rarely seen in global commodity markets. It declared force majeure. That is a legal term, and what it means in practice is this. Qatar told every country it ships gas to, every long-term buyer in Europe, in Asia, across the world, we cannot deliver. The contracts are suspended. Within days, over 150 tankers were stranded at anchor, unable to transit the strait. Asian spot gas prices surged 137% in under a week. LNG tanker charter rates doubled to $200,000 per day. Leading maritime insurers canceled all war risk coverage for vessels in the region. The world's most important energy choke point had become a wall. Now, an energy shock of this kind would be serious for any economy, but for Europe, it was something closer to an existential threat. And to understand why, you need to know what Europe did after 2022. When Russia invaded Ukraine and pipeline gas from Moscow dried up, Europe made a bet. It replaced Russian gas, which had been cheap, continuous, and delivered by pipe, with liquefied natural gas shipped by sea, primarily from the United States and Qatar. Russia's share of European gas fell from 40% to just 6%. By 2025, the U.S. became the dominant supplier, providing 60% of Europe's LNG imports. European leaders called this diversification, but it was not diversification. It was a trade, exchanging one geopolitical vulnerability for another. Pipeline gas flows continuously. Seaborne gas passes through choke points, and now the choke point had closed. European gas storage fell to 30% of capacity, the lowest since the 2022 crisis, and 30% below the seasonal average. Germany's storage sat at roughly the same level. The Netherlands dropped to just 10%. Goldman Sachs warned that if the disruption lasted 2 months, European gas could reach €100 per megawatt hour. Germany was already in trouble before this. 2 consecutive years of negative GDP growth. Over 24,000 corporate insolvencies in 2025, the highest in a decade. BASF, the world's largest chemical company, had already cut nearly 5,000 jobs and permanently closed plants. ThyssenKrupp, the steel giant, announced plans to eliminate 11,000 positions, 40% of its steel division. A Federation of German Industries study found that 1/5 of Germany's total industrial output could permanently disappear by 2030. The energy shock did not create this crisis. It accelerated one that was already underway. But the damage does not stop at industry. Natural gas is not just fuel. It is the primary feedstock for nitrogen fertilizer. When gas prices spike, ammonia plants shut down. Because the gas is not just powering the factory, it is the raw ingredient. This happened in 2022, when 70% of European ammonia production went offline. It is happening again now. And when fertilizer prices rise, food prices follow, not immediately, but within 3 to 6 months. The second-order effects of this energy shock have not yet arrived at the grocery store, but they are coming. Meanwhile, the European Central Bank was caught flat-footed. Its entire macroeconomic framework for 2026 and 2027 had been built on one assumption: that energy prices would remain flat or decline. A 70% gas spike invalidated that assumption overnight. Peer-reviewed models show that a 10% gas price increase raises euro area inflation by 0.6 percentage points after 1 year. The math on a 70% spike is devastating. The euro fell 3.5% from its January high, making dollar-priced energy imports even more expensive, creating a self-reinforcing loop. Cut rates and inflation spirals. Raise rates, and what remains of European industry collapses. The ECB is trapped. The energy shock would be dangerous enough on its own, but it did not arrive into a healthy economy. It arrived into an economy that was already fracturing. In oil markets, in equities, in credit, and in the labor market. And each of those fractures is now feeding the others. Start with oil. West Texas Intermediate crude went from $67 to $91 a barrel in a single week, the largest weekly percentage gain since WTI futures began trading in 1983. In subsequent days, it touched 120 before settling around 107. Now, the instinct is to focus on the price level, but the level is not what matters most. What matters is the speed. Every major recession in modern history was preceded not by high oil prices, but by rapidly rising oil prices. It is the velocity of the move that disrupts supply chains, spikes input costs across every industry, and forces central banks into impossible decisions. Transportation costs rise immediately. Petrochemical inputs follow within weeks. Food production costs within months, and headline inflation within a quarter. A 35% weekly oil spike is not a headline. It is a mechanism. The mechanism that has ended business cycles before and is now active again. Turn to the stock market. The S&P 500 peaked in late January. It has not crashed. It is doing something quieter and, in many ways, more dangerous. It is rolling over, a slow, grinding decline that happens in the denial phase, while investors insist the dip is buyable. The price-to-earnings ratio sits at 28. During the last major oil crisis in 1979, it was 8. That comparison is not for drama. It is a measurement of how much further there is to fall if this environment persists. But the risk that keeps institutional investors awake is not in the public markets. It is in private credit, a $3 trillion sector that barely existed 15 years ago. After the 2008 crisis, regulations pushed banks away from lending to riskier borrowers. Private firms stepped in. Apollo, Blackstone, Blue Owl Capital. They made loans, trillions of dollars worth, to small and mid-sized companies that traditional banks would no longer touch. And here's the critical detail. Those loans are not marked to market. The firms that made them get to decide what they are worth. The industry calls this mark to model. Critics call it mark to fantasy. When investors at BlackRock recently asked to withdraw their money from a private credit fund, the fund said no, approving only 54% of redemption requests and capping withdrawals at 5%. When a fund will not let you leave, that tells you something about what the assets inside it are actually worth. An ex-Lehman Brothers vice president recently noted that securities being carried at full face value on fund books are now being marked to 0, going from par to nothing in a matter of weeks. He counted 2 known problem spots 6 months ago. Today, there are over 17. Jamie Dimon of J.P. Morgan used the word cockroaches, and the implication was clear. Where you see one, there are many more behind the walls. And this brings us to the trap at the center of it all, the debt. The United States needs to refinance approximately $10 trillion in government debt this year. That is not a projection or an estimate. It is a calendar event, and the Federal Reserve faces a dilemma with no clean exit. If it cuts interest rates to ease the refinancing burden, it risks unleashing inflation, especially with oil prices surging. If it raises rates to fight that inflation, it triggers a recession in an economy already shedding jobs. If it does nothing, the refinancing cost at current rates is staggering on its own. For the first time in 25 years, U.S. Treasury bonds are selling off during a geopolitical crisis, not rallying. In every prior crisis, September 11th, COVID, the Russia-Ukraine war, investors fled to U.S. bonds for safety. Now they are doing the opposite. Yields are rising, meaning investors are selling. Part of the reason, China, which holds enormous quantities of U.S. debt, gets 90% of its oil from Iran. It has every incentive to retaliate economically. The labor market is already weakening beneath all of this. January layoffs were the highest since 2009. The economy shed 92,000 jobs in February, but the monthly number does not capture the full picture. The United States needs roughly 2.5 million new jobs per year just to keep pace with population growth and workforce needs. It has been averaging about 1 million. The cumulative gap is now 8.7 million jobs, a deficit that does not show up in any single month's headline, but compounds quietly in the background. That gap is now visible in housing. In Laredo, Texas, mortgage delinquency rates have reached 24%. Nationally, home sales have hit decade lows, and this is with mortgage rates at their lowest point in 3.5 years. In a normal cycle, low rates stimulate buying. This time they are not. Because the low rates do not reflect economic strength, they reflect weakness, and buyers know it. The foundation is not cracking from one thing. It is cracking because everything is happening at once. The energy shock amplifying the debt problem constraining the Fed, the constrained Fed, unable to support the labor market, the weak labor market dragging down housing, and all of it circling back to an inflation dynamic that has no simple policy answer. In an environment like this, capital does not sit still. It moves. And right now, it is moving in two very specific directions. The first is hard assets. Gold has reached $5,200 an ounce. But the price is not the story. The story is in the earnings. Most gold mining companies reported their latest results based on gold at $4,100, because there is a lag between spot prices and reported financials. At $5,200, with largely fixed production costs, the operating leverage is extraordinary. Miners are generating cash at rates the market has not yet priced. Some are beginning share buybacks. The same capital return strategy that powered the technology megacaps for years. Gold supply itself is declining even as prices rise due to geological depletion. Central banks are buying at the fastest pace in modern history. The supply is shrinking, the demand is structural, and the repricing in mining equities has barely begun. Silver has tripled in a year, from under $30 to over $80. But this is not 2011. In 2011, silver's spike was speculative momentum. This time, it is being pulled by two forces simultaneously. Monetary demand, as investors seek alternatives to depreciating currencies, and industrial demand, from solar panels, from electric vehicles, and increasingly from artificial intelligence infrastructure. The United States has declared silver a critical mineral for national security. China controls 73% of global silver smelting. America is building its first domestic silver smelter in 50 years, an $8 billion joint venture backed by the Department of Defense. Hard assets are not a trade right now. They are a structural position. The second direction is digital infrastructure. Bitcoin's price is down. The chart has been a textbook midterm year cycle. Weakness into February, a brief rally in early March to 73,500, and then a fade. Analysts tracking prior cycles see no meaningful price move until the third or fourth quarter. But beneath the price, something else is happening. Kraken has obtained a Federal Reserve master account, the first cryptocurrency firm in history to do so. The new CFTC chairman, who spent years defending crypto companies against regulatory assault, is now building statutory frameworks designed to survive future administrations regardless of their political direction. Michael Saylor's company is purchasing over 2,000 Bitcoin daily, 4 times the rate at which new coins are mined. And the 20th million Bitcoin has just been created. The remaining 1 million will take 114 years to produce. The rails are being built. Whether you choose to use them is a decision you will make later, but the option is being created now, and options have value, especially when the systems they exist alongside are showing strain. An energy shock struck an economy that was already fragile, and the fragilities are feeding each other. Capital is flowing toward hard assets and toward new financial infrastructure, away from the assumptions that have guided investment for the last 4 decades. Bonds selling off during a war instead of rallying, rate cuts signaling weakness instead of stimulus, an entire continent's energy strategy collapsing in a single week. This is not a correction. This is not a cycle. This is a regime change, and regime changes reward those who recognize them early.